Hey guys, and welcome back to the channel. Today, I'll be going over the biggest tax mistakes that I see small business owners make. Mistakes that not only cost them time, but also money. I'm Crystal, CPA and co-founder of Life Accounting. Now, I completely understand that if you're watching this video, chances are you're a new business owner, and though your intentions might be good, you don't necessarily know everything to do when it comes to your taxes. Well, this video will highlight some of the things not to do as a new business owner or as a business owner in general from a tax perspective. Now, the first mistake that I see new business owners make is not having a separate account for just their business. It is so important to do this so you can clearly keep track of all of your business income and expenses. After all, you want to make sure that you write off as many business deductions as possible. And in order to do that, you need to have organized records. Too often, I see new business owners operating from their personal accounts, which just creates a big mess at tax time. Some business structures like LLC or C Corp are actually required to have a separate account for their business, or else their business is at risk of being shut down. More importantly, for you as the business owner, it would be nearly impossible to know where your business stands financially without separating your business and personal finances. You can open a business account at any major banking institution. You just need to make sure that you have an employer identification number set up first for your business in order to do that. Second mistake I see a lot is business owners not making their quarterly estimated tax payments. If you don't make quarterly tax payments, the IRS is going to assess big penalties and interest on the tax that you owe. This can easily be thousands of dollars. Let me break down what estimated tax payments are. When you work for someone else as an employee, your taxes are automatically withheld and paid by your employer to the IRS and state agencies throughout the year. For most employees, this is why little to no taxes are due when they file their tax return, because it's already been paid on their behalf. But for business owners, it's different. Since you are the employer and the employee, you need to make sure you pay your taxes at least quarterly throughout the year. The IRS basically prefers to get their money throughout the year than at the end of the year when you file your taxes. But how much should you pay? Well, it depends. There's an IRS Form 1040-ES that helps calculate what you should pay in quarterly taxes. A simpler method is paying 110% of the prior year's tax. So for example, if your tax expense last year was $100, 110% of that is $110. So you can break up that $110 by 4 quarters and pay $27.50 per quarter as your quarterly estimated tax payment. This way, the IRS cannot assess any failure to pay penalties on you. However, failure to paying your quarterly estimated tax payments will result in more money being owed in penalties and interest. The third mistake is not reporting all of your income. When you receive any kind of tax document like a 1099 or even a W-2, that same form has already been filed with the IRS. This means the IRS already knows how much income you've earned during the year, and a lot of times they know even before you know. If you file your return without including this income, you will almost certainly receive an IRS letter in the mail outlining the discrepancy and any additional tax or penalties that are due. And no one wants that. To avoid this, report all of your 1099s you receive from your customers or other sources on your tax return. If you process credit card payments, you should receive a 1099-K from your merchant, which shows all of the payments they've processed and remitted to you during the year. The fourth mistake is reporting clean figures. For example, clean figures might look like deducting exactly $300 in supplies, or $700 in travel expenses, or exactly $500 in vehicle expenses. Do you see the trend here? All of these deductions end with zero. Though it is not completely impossible for this to happen, it is just extremely unlikely. This kind of mistake kind of goes with mistake number one and not separating your personal and business expenses. Quite often I see business owners with clean figure expenses because they are estimating the expense since they didn't keep track of the expenses during the year. And when the IRS processes a return, it is ran through a machine or software and it picks up on things like this. So it will definitely raise a red flag and could easily result in an audit. And we don't want that. To avoid this mistake, make sure to have some kind of accounting system in place that keeps track of your actual business expenses. The fifth mistake is filing late. March 15th, April 15th. It is the same every single year and it's never convenient. It's never fun, but it has to get done. I see it time and time again, business owners filing their business and or their personal tax returns late. If you need more time to file, you can always file an extension, which will give you an additional 6 months after the original due date. So for most of you, that would extend to September 15th or October 15th. Failing to file on time, either the tax return or extension, will result in, you guessed it, penalties, unnecessary penalties. So do yourself a favor and set an annual reminder to file both your business and personal tax returns. Also, I want to mention that filing an extension does not extend the payment of your taxes. So as mentioned before, pay at least 110% of the prior year's tax, and that should save you from failure to pay penalties. The sixth mistake is having an inactive or dormant LLC. Perhaps you started an LLC with the big dreams of having the best online store or marketing agency or real estate firm, but just never got around to actually making it happen. Don't feel bad, this happens a lot. But what happened to that LLC you created? Did you pay the annual state fees? Did you file the tax returns for it? The thing is, once you open an LLC or business, you now have an obligation to keep it in good standing, regardless if you made any money or not. Those fees accumulate year over year. So if it's been 3 years, you'll have to pay the fees associated with all 3 years to be in good standing and legal to operate. So make sure if you opened an LLC or business in the past that you officially dissolve that company so that you don't owe any state fees or have any tax return requirements. The seventh and final mistake is failing to be taxed as an S corporation. We actually have a video on this channel covering the ins and outs of S corporation taxes, so be sure to check it out when you get a chance. But electing to be taxed as an S corporation can literally save you thousands of dollars in taxes. Most business owners pay tax based on the default treatment of their entity type. So for most LLCs, there's a self-employment tax of about 15.3% that is assessed based on the entire income of your business, compared to an S corporation where self-employment tax is only paid on the salary that you paid yourself from the business. Any amount above your salary is not subject to self-employment taxes. Electing to be taxed as an S corporation only makes sense after you reach a certain level of income from your business. But as you start earning 60, 70, 80K or more, I highly recommend you look into S corporation status to reduce your self-employment tax liability. I hope you found this video informative. If you did, please give it a thumbs up and subscribe to our channel if you are new, and I'll see you in the next video.